Hello, friends. Last week, the markets ended with mild gains. What's the outlook this week? Is India likely to remain an outperformer as compared to its global peers? Let's find out. So, diving right into the market, you can see on your weekly market roundup window that it was the Bank Nifty that led the way higher, gaining marginally more than the Nifty 50. The US dollar index managed to rise a bit, but in spite of that, commodity markets jumped. So the bullion rally was led by silver. Unfortunately for us, crude oil prices also jumped. That raises inflationary fears, and the US dollar index, the dollar versus the Indian rupee, hit a new high. The 10-year benchmark bond yields jumped, not surprisingly. I've been mentioning this on my social media accounts, and I'm sure those of you who've subscribed to my Telegram channel have read the free update that I wrote on what the implications for banking stocks and bank nifty are of the bond yields. NSE gained market capitalization and market-wide position limits, MWPL, rose as well. The US markets gained with the Dow Jones Industrial Average leading the way, followed by the S&P 500 and then the Nasdaq 100. On your screen now is the chart of the US Dow Jones Industrial Average. It gained in the first two trading sessions of the week, and the remaining 3 days were bearish. Friday's close has been exceptionally weak, and we have closed below the last mile support swing low of 29,889. The longer the Dow Jones Industrial Average stays below 29,500, the weaker the outlook will be. Taking a look at the Nasdaq 100, which has a direct bearing on our information technology or IT stocks, what we can see is that it is precariously poised at the 11,037 levels. Staying sustainably below this mark will weaken Indian technology stocks further. Now for the S&P 500, which again has shown declines just like the Dow Jones Industrial Average. The largest decline has come on Friday. The only difference being that this index has closed, it's lost on 2 out of 5 trading sessions as compared to the others. But in all the 3 indices, the death cross remains in place where the 50-day moving average is below the 200-day moving average. So the US markets triggers remain bearish. Now for the MWPL, market-wide position limits. This is a percentage exposure built up by traders as compared to the exposure allowed by SEBI. What we are seeing is a smart rally after the expiry of the September derivative series, which is along routine lines, and risk appetite is rising, albeit slowly. Now for the index and stock futures turnover, cumulative series of 3 expiries, so which is October, November, December, what we are seeing is that stock futures turnover last week collapsed to almost the 20-week or a 5-month low. The index futures turnover, which a week before last was the highest in 5 months, has also come down sharply in the lower half of the 5-month range. So higher levels did not find too many buyers. That's the moot point. The advanced decline ratio, which had jumped to 2.53 on the previous Friday, has come down to 1.20 on last Friday. So this is a one marshmallow gauge of risk appetite, and it's clearly telling us that buying momentum had slowed down last week. Now for the basis. Basis is nothing but the premium or discount enjoyed by the future compared to spot, and it also measures the risk appetite which the traders are displaying. Being able to or wanting to pay a higher premium shows higher risk appetite, and week on week basis, both the indices are not showing any great signs. The Bank Nifty's basis has actually come down. So here I see some amount of profit taking at higher levels. whereas the Nifty 50's basis has gone up. Do remember, this is the first week after expiry, so basis should have gone up typically, but the extent of the rise is very, very insipid, which tells me that bulls are not biting very hard. Now for the impetus chart, and the impetus of the Bank Nifty, which had gone to a 5-month high last week, has kind of fallen very, very sharply. The impetus for the Nifty 50, which had hit a 9-week high in the week before last, has come down sharply as well. So the prognosis of what has happened last week is the indices might have risen on a week-on-week basis, but the impetus is saying that the rally lacked the force of enough buying. So the rally is on thin ice. Now for the LWTD chart, the Nifty percentage gain loss line has fallen below the zero mark. It has closed at minus 0.10, but the LWTD has closed exactly in neutral territory at 0, which means the bulls and bears are both evenly matched. They are sitting on the fence and both do not want to enhance their exposure too much. This is not exactly very great news. Now for the footprint of the four types of market participants, starting with the FII, they've cut their index net short positions marginally, but they've gone net short in individual stock futures. Not much of a change in individual stocks, but the fact is that they were mildly long and now they are mildly short. Where DIIs are concerned, they've pressed sizable amounts of shorts in index futures. As a matter of fact, they've more than doubled their index net short positions. Where individual stock futures are concerned, they've reduced their short positions by almost 9,000 lots, which is neither here or there. Where prop traders are concerned, and this is a revelation, prop traders have actually reduced their overall net long positions in individual stocks in spite of the fact that a new derivative series has started. And on the other hand, where they were net short in the week before last in index futures, they are now mildly net long by 79 lots. So prop traders are not really very gung-ho. They are not buying big into the market rally of last week. Where retail traders are concerned, they've enhanced their individual stock long positions mildly, ditto for the index futures. So nothing earth-shaking happening out here. Friends, the indicators done. I now come to the signals given by the four index heavyweight stocks. Whichever way these index stocks go, they tend to have a pull-push impact on the indices. The banking stocks, HDFC and ICICI, have an impact on both the Nifty and the Bank Nifty, so they are doubly important. On your screen right now is the biggest boy of all, Reliance Industry, with a weightage of 10.84, which has come down in the last few months because of the stock price has been falling. The beta has risen to 1.11 and the stock is below its support levels. The last 1 week saw a mild pullback starting from Monday. Monday was a day when the headline indices and individual stock futures saw a sharp pullback. But we need to go above the 2,550 levels sustainably on a closing basis and then attempt to cross over the 2,618 levels if the bearishness in Reliance is to go away. That's taking a while. So Reliance is showing some signs of hope, but it's not yet out of the woods. Where HDFC Bank is concerned, it's respecting the supports at 1,421 and 1,410. The price has closed below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the near-term traders are under pressure. I would ideally want the stock to trade above the 1,480 levels because it has a 8.27% weightage in the Nifty and 26% weightage in the Bank Nifty. So this stock takes both the indices with itself. Infosys has seen a reduction in the weightage in September as compared to August, No surprises, the stock had fallen. So the weightage is down to 6.84. Beta remains constant and the price is still respecting the 1367 support level. I have a feeling if the Nasdaq 100 was to fall and close 1 or 2 weeks net negative, I believe Infosys will see some sizable amount of selling pressure. So let's keep our ears to the ground and monitor the overseas market cues. ICICI Bank with a weightage of 7.94, which has gone up in September as compared to August. No surprises, the stock has been bullish. Bank Nifty weightage is 24.97, which is second only to HDFC Bank. The stock has managed to close above its 25-day exponential moving average, which is a month-long holding on cost of a bull. And it has also closed above the 867 mark, which the bulls will need to defend. Last desperate mile support would be 836. If the stock was to start drifting below this level on a sustained closing basis, I believe the bulls are in trouble. Friends, the studies done, I now come to the bond market. Now, clearly, this market, in my humble opinion, is likely to grab more and more of your attention in the coming weeks. Do note that the 10-year benchmark bond yield is now at its highest in almost 4 months. We've closed at 7.51 on Friday, and that is telling you that bond prices are lower, which is why the yield is higher. There'll be a mark-to-market loss on the banking companies' portfolios, which are the largest investors in bonds. And let's not forget, interest rates are rising, so cost of funds is also likely to rise. This is an aspect that I have been covering in my weekly videos for many, many quarters now. We've been ahead of the markets in keeping you ahead of the curve, ahead of the crowds. Please don't let anyone tell you otherwise, that the bond markets are unimportant, even if you are just an equity or a bank nifty trader. There is a pull and push of all asset classes within all the other markets that are prevalent in the financial system. So let's watch the 7.27, 7.29 small band as a band of support. It's a very critical support as far as I'm concerned. And I'm expecting the 8% mark to be reached in the coming few trading weeks. Would I resort to further deployment of funds in the fixed income securities market, especially sovereign investments at 8% plus? No brainer. Yes, I would. So continue to ladder your fixed income investments, particularly sovereign. Friends, the bond market done, I now come to the US dollar index, which is a very critical aspect for emerging markets, including India, because we are import dependent and we basically tend to import inflation when the dollar rises, because all the landed prices of imported goods are higher with a rising dollar. What you are seeing on the daily chart of the dollar index is that it rose on 3 out of 5 trading sessions, the last 3 trading days of the week. The price has closed above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. It closed only 1 day below that moving average. So that average itself is a fairly good barometer of support and resistances. The short-term outlook remains bullish for the US dollar, but any break below the 110 mark could be a sign of trouble. The weekly chart, which showed an inverted hammer in the week before last, has been followed up with a bullish-bodied hammer on the weekly chart of last week. That means a whole lot of tug-of-war going between bulls and bears. The price is far above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook remains positive. But the difference, the distance between the price and the moving average tells me that there could be some amount of mean reversion, which means the price could go sideways and the average catches up, or the price could fall towards the average. So the runaway rally in the US dollar index seems to be catching its breath for now. Let's see whether it's likely to resume again. For that to happen, you'll need to have the US dollar index close above the 114 levels all over again. Friends, last week I advocated a range between 114.35 on the upside and 110 on the downside, which was admittedly breached because the low was 109.965. In the coming week, I expect an estimated range between 114.95 on the upside and 110.55 on the downside. Do keep a close eye on this aspect of the market as well. Friends, I now come to the Bank Nifty, which led the rally because it gained 1.41% by rising on 3 out of 5 trading sessions, as you can see on your daily chart. Now, what we've seen is that the rally on Monday was the biggest candle last week, and it is only because of Monday that bulls were saved the blushes on a week-on-week basis. The rally, notwithstanding, the price has still closed below its 25-day exponential moving average, which is a month-long holding on cost of a bull. Thursday saw an inverted hammer on the Bank Nifty, and the high of this hammer will need to be overcome on a closing basis if the bulls are to retain or regain control from the bears. The immediate previous swing low at 37,386 will be a level that the bulls will need to defend with all their might in case of any declines. So let's watch that level very keenly. On the weekly chart on your screen now, what you're seeing is that a bullish engulfing pattern is seen after a bearish hammer on the week before last. The price remains above its 25-week exponential moving average, which is a 6-month-long holding on cost of an average bull. So the medium-term outlook also remains positive, but for now. We need to trade significantly higher, possibly above the round number of 40,000 to be able to rope the bulls back in the game all over again. So that is one aspect we need to see. Friends, in the week before last, this index was number 2 on the most volatile list on our in-house statistical beta list, and it slipped one notch to close the week at number 3 on the most volatile counters list. It still remains very high for my comfort for a frontline index to be number 3 in the most volatile list, because that raises the challenge for the retail trader. Last week, I advocated a range between 40,250 on the upside and 37,000 on the downside, which held perfectly well. In the coming week, I expect a range between 40,800 on the upside and 37,550 on the downside. I continue to remain of the opinion that you should trade extremely light, maintain your stop losses, because the probability and the statistical weight of evidence, which I have shown you of the impetus, the advanced decline ratio, the LWTD, is not really supporting the bulls outright. It's actually cautious with a tinge of caution telling you that, hey, the markets might just slip through the floor anytime any bad news comes. So this is a time to be cautious. Coming to the Nifty, what you are seeing is that this index surrendered 1.29% on a week-on-week basis. It rose on 3 out of 5 trading sessions, and the daily chart on your screen tells you that like the Bank Nifty itself, the biggest gains came on Monday, but for which this index would have also closed in the negative. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So recent buyers are under pressure, and the inverted hammer of Thursday tells me that the price needs to surpass the 17,450 or maybe even 17,500 to be safe on the closing basis before bulls can venture out and buy. The immediate swing low of 16,974 made in June remains a support area that the bulls will need to defend in case of declines. If this support does not hold, bulls are clearly in trouble. The thick bearish red trend line connecting all the peaks made from October 2021 to now is above 17,650, and that is likely to be an overhead hurdle on the upside. So the Nifty needs to cross quite a few hurdles before it can convince the bulls into buying all over again. The weekly chart on your screen tells you that the price has breached the 25-week exponential moving average, which is a 6-month holding on cost of an average bull, but closed above it. And the price is far closer to the 6-month, the 25-week exponential moving average, which means mean reversion has already set in. What we now need to see is whether the price is breaching and closing below this moving average sustainably. That would be a sign of weakness if it does. Friends, in the week before last, this index was at number 8 on the most volatile counters list in our in-house rankings by statistical beta. It rose one notch to number 9. Why did it do that? Because the individual stock futures volatility rose faster than the Nifty 50. It's not that the Nifty's volatility has come down sharply. So it still remains a challenge as far as bulls are concerned, but not as challenging as the Bank Nifty by itself. Last week, I advocated a range between 17,650 on the upside and 16,525 on the downside, which held perfectly well in spite of all that volatility. In the coming week, I expect a range between 17,875 on the upside and 16,750 on the downside. Friends, the index done. I now come to the last chart of the week, the retail risk appetite as shown by their footprint in the options and futures space. What we did see was the overall turnover in options and futures in both the indices and index, the individual stock futures have come down last week. But within that fall, what contributed the most amount of turnover? It was basically, as the sky blue line, the light blue line tells you, that it was stock options which saw higher turnover as compared to the component of last entire week. And the olive green line also tells you that individual stock futures turnover also was higher on a week-on-week basis. So risk appetite was definitely higher. When retail traders take exposure in stocks, which gyrate between 3 to 3.5% intraday basis, as compared to the indices, which gyrate between 1.25 to 1.75% on an intraday basis, it's telling you that the bulls attempted. But will they attempt similarly coming week? Because last week's attempt did not really get them too much by way of profits. That remains to be seen. Now, these are metrics that I keep putting up on my social media accounts every day late in the evening. So please do connect with me. And there's a whole lot of statistical, very simple but accurate data being put up on our Telegram channel. So please do take the effort of joining our free channel on Telegram. The hyperlink to the same is in the pinned comment and in the description below. Friends, I now come to the most popular segment of this video for statistical model traders. I give you 5 stocks which have gained the highest amount of impetus on Friday. So on Monday, you take small exposure, wait for large price moves. And 5 stocks which have lost the most amount of impetus on Friday. So you take large exposure, wait for small price move. That is for scalpers. The direction of buy or sell will be determined by the snapquote window, which is a separate tutorial I have put up in my YouTube channel. So the direction in which way you should trade is determined by the snapquote window. The high impetus gainers list is led by Persistent Systems at number 1. Number 2, Lupin. Number 3, Motherson Sumi. Number 4, Zydus Life. Number 5, TCS. The impetus losers, where you take big exposure, wait for small price moves, is led by Shree Cements. Number 2, MFSL. Number 3, Power Grid Corporation. Number 4, Sriram Transport. And number 5, JK Cements. Do remember, friends, this list is valid only for Monday. Should you want to update yourself with this list Tuesday through Friday, please join my Telegram channel or request to be included in our WhatsApp list, wherein we broadcast this list on a daily basis. Before I draw this video to a close, my friends, I remind you to subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here, good, bad or ugly. I'm always eager to have your feedback in the comment section and help me reach out to fellow like-minded smart traders like yourselves by sharing my video in your social media groups on WhatsApp, on Facebook and Twitter, etc. and help me reach out to a wider audience of like-minded people. I wish you have a very, very great and profitable week ahead. Thank you for your patience in being with me in my video. Till we meet again in my next, this is Vijay Bhambwani signing off for now. Have a great week. Bye-bye.